Hello and welcome to the Trades and Tutorials video. This is Jeff Bish, president of MarketGauge.com. And in this video, I'm going to take a look at whether or not it's time to buy China. Now, before I get into why we might want to buy China for both some basic reasons and for some more proprietary reasons, i.e. an indicator that most people can't see, I want to make sure that if you're just finding us on YouTube, that you know to subscribe to our channel to get these videos as quickly as possible. Also, you can find more videos like this at marketgauge.com/tutorials, and even more information from us on Twitter at MarketGauge and at Market Minute. And of course, if you're seeing this on Facebook, please like us and make your way over to our site. So with that said, let's get started. FXI, the major proxy for the Chinese market, looks like it may be bottoming for a number of reasons. Now, first of all, FXI and China really isn't on the list of trends or areas of the world that at least I've been hearing anybody talk about buying. But if you take a look at a very basic pattern, one of the first patterns that I would look for in a major bottom, China's already started it. And that is the 50-day moving average here is the blue line. The 10-day moving average is the magenta line. The 200-day moving average is the green line. So it's had a really sharp decline. Probably don't need to tell you that. And we'll look at the big picture in a minute. So the first step of identifying this as a potential bottom is that it made a really substantial move up and through the 50-day moving average. Once you go up through the 50-day moving average, you want to look for the top of whatever potential base exists. And so that top of the base really sits just over this 31 level, and it's pretty good. It's got a high there, it's got a high there, and really it's got 3 or 4 days that lend themselves to support in that area. And so this is the area that you want to look for the market to come back to. Oftentimes it doesn't, but if it does, as it has, you want to start looking for some kind of a turn to the upside. That's where the 10-day moving average comes in, and here's the 10-day moving average. So today we've taken out the 10-day moving average. I have a whole quick series of steps that would define that the move above the 10 is confirmed and ready to move higher. We're not going to get into that in this video, but the first of those steps is that it breaks through, it closes over it. The compelling part about China, though, is not just that it broke a 10-day moving average. That's certainly not enough reason to believe that this could be a pretty significant low. One reason is that it's pulled back to this support level in here. And again, from a more traditional point of view, the other reason to look at this 32 level is if you look at this blue line that I put in earlier at the 32 level, and we look back over the last 3-4 years, you can see that this 32 level has been a major area of support. And here you can also see this ugly decline and why nobody's really looking at China in a very favorable way. Everybody's remembering this decline and worried that China's going to continue to slow in growth. But the fact is that it took out this major support level. Now it came back up above it. Now it's coming back to test it. This is exactly the time you want to start looking at establishing a longer term position with a really tight risk. Now there's another reason you would want to look at it, and that is at least a reason that we have, and that is we have an indicator which we call real motion. And that's the indicator you can see down here. So the idea behind real motion is that it's tracking momentum that you can't really see with normal indicators. And it's as easy, one of the ways to look at it is as easy as looking at what's going on in the price chart and comparing to see if the same thing is happening in the momentum chart. So if you look at this green line, that's the same concept as the green line up here. So this is a 200-day measure of momentum. This is a 50-day measure of momentum, just like this is a 50-day measure of price. And the dots are a 1-day measure of momentum. So what we have in this real motion indicator is we have our 50 relative to the 200 turning bullish long before the price has done that. Now this indicator will often move ahead of the price. This isn't a great example of it up here, but you can see as price was breaking the 50-day moving average, momentum was not only breaking the 50, but also breaking the 200. So the momentum up here may have looked like we were just pulling back to the 50, consolidating under the 50, but down here, the momentum was really telling you, or real motion was really telling you that this pullback is really much weaker than it appears to be in price. And you can see that the breakdown from a cross point of view, while it's not always going to be, in fact, usually isn't necessarily a very timely indicator, it is a very significant overall indicator. So this break here is telling you that the breakdown below this 200 is really not a short-term problem. It's a longer-term problem. And we're getting the opposite situation right here. So the momentum is turning up in a much bigger way than the price would lead you to believe. Now, as I said earlier, we don't want to just make a bet that the market's going to turn just because it's crossed a 10-day moving average. Likewise, we don't want to make a bet that the market has turned just because the momentum has turned. We want to wait until they both concur or agree. Right? So the couple things that are going on here are that not only has the momentum shifted from a longer term perspective, but this pullback in price, which came back to under the 50-day moving average, was not really confirmed in the same way with momentum. So the momentum, or the real motion, came back, has pretty much held the 50-day, and now is moving higher. So the momentum's over its 50-period value, whereas the price hasn't gotten there yet. So if I put all these things together, I have what looks like a really tight setup. And I would define it like this. And this isn't to say everybody should go out and take this trade, but this is how we would measure it at Market Gauge, right? If this turns out to be the entry point around 32 and change, the widest stop would be under these lows, which is $1 away, which is about 2 average ranges. We cover a lot of that in our courses. If you're already a member, that'll make a lot of sense. But even if you're not worried about average ranges, that's a $1 risk. If all this does is go back up to these highs from 32 to 35, that's $3. So there's your 3 to 1. But I'm not just looking at this for 35. As you saw from the bigger picture on the charts earlier, this bottom could be a much bigger bottom. And that bigger bottom, I would then look at the next level. If it just were to come back up to the areas that it was in just last October, that would be 40. So now you're talking about an 8 to 1 risk-reward ratio. And finally, if we take a look at Hong Kong, a related index, it has the exact same situation going on with its real motion indicator. So we'd like to see that in terms of a confirmation. And its price is actually much stronger. As you can see, the price, while it's coming over the 10, the 50-day moving average is now over the 200-day moving average, and its pullback didn't even come back into that basing area that we saw in FXI. So put all this thing together. Is today the actual day? Maybe today is a good first day. It's likely we're going to see some volatility around this level, and there'll be other opportunities to get in. But one of the things to keep an eye on is whether or not these two indexes hold their recent lows of the last week or two. So hope that helps. And if you want to learn more about the real motion indicator here, there's probably a link in the text above this video. And for now, best of wishes in your trading, and I'll see you in the next video.